Great, great. Thank you very much. So as you said, this is joint work with Shiyang, Subra, and Liyan. I think Shiyang is also in the audience, which is great. And what we want to do in this paper is we want to provide a theory of a model in which some investors obtain information about betas. And that's going to be the novel contribution of our paper. So what's the motivation? Well, the motivation is basically something that we teach to our students every semester. You can think of a firm's cash flow as sort of a function of firm-specific factors. And then also firms' cash flows depend on market factors or systematic factors. And we usually call the loadings on these factors that determine the co-movement betas. And at the same time, we also sort of agree on the fact that acquiring information in financial markets is absolutely crucial, just because it allows investors to make larger trading profits. And so in practice, some of that information acquisition is also about betas, right? So for example, if you look at the CFA exam, they really emphasize the fact that you have to estimate the cyclicality of cash flows, and estimating the cyclicality is nothing else but estimating the beta of the cash flow. And those betas change over time, right? So I have a couple of examples on the slide just to motivate why it's important to forecast betas. For example, consider a couple of important acquisitions that took place in the past. Amazon acquired Whole Foods, Verizon acquired Yahoo. And obviously those acquisitions must have changed, for instance, the market betas of those companies. And speculating or acquiring information about those acquisitions ex ante is nothing else than speculation or information acquisition about betas. Another motivating example is Nokia. Nokia started as a paper manufacturer, but then transitioned into personal electronics. And then again, acquiring information about that transition is also an example of learning about betas. Now you might say those are very rare events, that they don't happen on a day-to-day basis. However, there are other sort of motivating examples I could give you, like for instance, speculating on operating leverage, like the mix of fixed versus variable cost, is also beta speculation. And then if you acquire information about the fact that a company might take projects in a different industry, that would also be an example of a decision that would shift the beta of a company. So the conclusion from this slide that I want to sort of convey is that learning about betas is a relevant feature of real financial markets, and therefore it's an important question to study. And so that's the gap that we're trying to fill with this paper, because on the one hand, as I mentioned on the previous slide, the fact that the factor structure explains firms' cash flows quite well is widely recognized, but at the same time, we don't really have theoretical models that allow us to analyze how traders should learn about both idiosyncratic information and betas. And that's what we want to do in our paper. So we want to explicitly model a firm's cash flow as having two components. So the first component is going to be the firm-specific risk. We're going to call this epsilon in our paper. And then the second component is the product of two pieces. So it's the factor loading, the asset beta, and then the systematic risk, which we will call theta. And so now epsilon and the second component will have an important difference. And so that difference is that epsilon affects the cash flow additively, while beta affects the cash flow multiplicatively. And so now you might think that this is just sort of a mathematical difference that doesn't really matter, but it actually has real economic content, right? So if you think about it, epsilon information being an additive shock primarily changes the expected cash flow. However, beta being a multiplicative shock changes both the expectation as well as the variance or the uncertainty about the cash flow. And that distinction will play a crucial role in our model. And I'm going to come back to this point a couple of times in the talk. Okay, so just a preview of our main results. So we basically have three main results. Two of those results are about price impact. The last one is about asset prices and returns. In terms of price impact, we have two results. The first one is that in equilibrium, price impact is going to be asymmetric. So it's going to be higher for large buy orders and lower for large sell orders. This asymmetry in turn is driven by the fact that price impact is also stochastic. So it depends on random shocks. Therefore, our model can generate liquidity risk endogenously. And we are very specific about the comparative statics of liquidity risk. So we're going to be able to make predictions about how model parameters such as factor volatility or average betas impact liquidity risk. And then the second set of predictions is about asset prices and returns. So we're going to show that there's going to be a positive covariance between price impact and order flows. You can see this from the first point here, because price impact is lower for low order flows and higher for high order flows. And this positive covariance will drive a wedge between the equilibrium price and the expected cash flow. Therefore, it creates sort of a risk premium for expected returns. And we will show that this risk premium can help to explain stylized empirical facts such as the beta anomaly and the leverage effect. And we will also predict that this covariance between order flow and price impact positively depends on betas and inversely depends on expected returns, or is inversely related to expected returns. And we will provide some empirical evidence for these two novel predictions. Okay, briefly about the related literature. So we contribute to two strands of it. The first literature is, of course, a very substantial one about informed trading in financial markets. This literature goes back at least to the 80s, to Grossman, Stiglitz, Kyle, and many, many other papers. Daniel, of course, has also worked in this area. A subset of this literature considers informed trading with multiple dimensions of uncertainty. And we also do something like that. The crucial difference is, however, that we consider an additive shock and a multiplicative shock. So the existing literature has not looked at acquiring beta information. And this is really different because beta information is a multiplicative shock that also affects the variance and not only the expected cash flow. And a nice feature of our model is that we can actually make beta, turn beta into an additive shock. And I will show you that our main results go away if that happens. So that in turn means that the multiplicative nature of beta is driving our results. Okay, and then the second set of papers that we can contribute to is the recent literature on uncertainty about betas. And so these, the papers that I list here, study the implications of beta uncertainty on asset prices and returns. We also have some results about that relationship. The key difference is that we have an asymmetric information model with privately informed agents, whereas the papers that I list here usually have a representative agent. Therefore, they don't talk about liquidity and price impact, which is sort of the driving force of our model. Okay, so now what I want to do is I want to talk a little bit about the model setup, then about the three main results that I've mentioned. Then I'm going to talk about one extension and very briefly about the empirical analysis that we conduct. Okay, so the model that we consider is actually very simple. So it's a static trading model. There's a single trading stage at t equal to 0. There are multiple assets. We're going to see in a second that we make assumptions so that this actually simplifies to an asset by asset analysis. And then at t equal to 1, the assets are liquidated and the economy ends. So the asset payoff crucially depends on two components. There's this firm-specific component epsilon j, and then there's the beta j times the systematic factor. So again, you can see here the key difference is beta j multiplies a random variable, the market factor, whereas epsilon j is an additive shock that doesn't multiply a market factor. So there are these three different dimensions of uncertainty: the market factor, the beta, and the firm-specific shock. Beta and epsilon will be the two important random variables in our analysis because trader can learn about those two dimensions of uncertainty. Both of these shocks have a similar distribution. They're binary. They can either take a high or a low value with equal probability. And so just to sort of come back to the point that I've made a couple of times, so if you think about the expected payoff conditional on information, you can see that, of course, higher epsilon or higher beta information increase the expectation of the cash flow. Okay, so in that sense, they play a similar role because they make investors more optimistic about the cash flow. However, if you consider the variance of the cash flow conditional on information, then of course the level of epsilon doesn't matter because you already know epsilon, doesn't change your uncertainty about the cash flow. At the same time, that's not true for beta j, right? A higher beta j means more systematic risk and therefore higher variance. So that's, again, the key difference between epsilon and beta information. So now a little bit more information about the trading framework. So we have three types of traders. There's a continuum of risk-neutral informed traders. They have private information about different components of the asset cash flow. I'm going to talk about that on on the second half of the slide, then liquidity traders with exogenous demand, and a competitive market maker for each stock. Importantly, we're going to assume that the market maker is risk averse, and that risk aversion is really important because it emphasizes the difference that I explained on the previous slide, that beta information also impacts the variance. And I'm going to come back to this point in a second. So informed traders are informed, and so they belong to one of two groups. There are epsilon informed traders and beta informed traders. Epsilon informed traders learn the firm specific shock perfectly. Beta informed traders learn beta perfectly. So they have masses chi epsilon and chi beta. In our main model, we're going to take these masses as exogenous. In sort of the second half of the paper, we endogenize those masses, and we can interpret that exercise as sort of capturing the long run response of the economy. Okay, so just a note. So in our main model, we assume that there is one market maker that makes the market in one asset only. We then have an extension with multiple market makers per asset, which is much more complicated, but we show robustness there. Then we also assume that informed traders are risk neutral. We have an extension with risk averse informed traders. And so those two assumptions combined imply that we can, in the main model, drop the J subscript and analyze the equilibrium asset by asset, which hugely simplifies our analysis. Okay, so for the rest of the talk, I'm just going to talk about a generic risky asset. Okay, so the optimal trading for informed traders is very simple. So they just, being risk neutral, they trade to maximize their expected returns. So YI is their position. V minus P is the dollar return, because V is the payoff and P is the price. And they choose their positions between -1 and 1, which is the position limit that we impose, to maximize that expected return. And then total order flow consists of total orders from epsilon informed, beta informed, and liquidity traders. The market maker observes total order flow and sets the price competitively. Now, this is important because here we follow Subra's 91 RFS paper and assume that the market maker is risk averse. Okay, so the market maker not only cares about her expected return, but also about the variance of that return. And so gamma represents the risk aversion of the market maker. Then we assume that the market maker earns some autarky utility, which is normalized to 0. Therefore, the equilibrium stock price contains this usual expected cash flow component, right? So if the market maker is more optimistic about the cash flow, she charges a higher price. But then secondly, if gamma is greater than 0, the stock price will also depend on the market maker's conditional variance of the cash flow. Okay, so being risk averse, she wants to be compensated for risk depending on the direction of trade. And that second component here is really important for our analysis because it emphasizes this economic difference between beta information and epsilon information. Right, because epsilon information will in equilibrium affect the stock price mostly through this first component. Beta information will affect it through both of these components. So then the equilibrium that we want to consider looks as follows. So informed traders, being risk neutral, will trade up to their position limits 1 and -1. They will buy on good news and sell on bad news. And then total order flow will reflect that information. The market maker takes that into account and learns from total order flow about the cash flow, and then sets the stock price based on the equation that I've shown you on the previous slide. And so then the equilibrium stock price will be an equilibrium, an increasing stock function of total order flow, which is very intuitive because a higher order flow just means that the market maker is more optimistic about the cash flow. Okay, so now I want to talk about the 3 main implications that I mentioned in the introduction. I want to start with price impact. For price impact, we have 2 kinds of results. The first set of results is about the shape of price impact. The second set is about the moments of price impact. Okay, so first of all, how do we define price impact? We follow the existing literature and simply define price impact. We denote it by lambda and define it as just the derivative of the stock price with respect to order flow, right? So intuitively, the lambda tells us by how much does the stock price change if total order flow changes by 1 unit. In our model, lambda takes a very simple form. However, it's at the same time, it emphasizes what we want to emphasize. So price impact is equal to or proportional to the market maker's conditional variance of the payoff. Why is that interesting? Well, because as I've mentioned probably 10 times now, beta information is important for this variance. Therefore, price impact and beta information will be closely linked through this relationship. There are two interesting results here. First, price impact is asymmetric in our model. It's higher for large buys, lower for large sell orders. And it's also concave, which just means that it's higher for intermediate order flows and lower for extreme order flows. Both of these findings are consistent with empirical evidence, but I want to mention that only the first one is really driven by beta information. Why? Because we can always conduct this exercise and basically turn beta information into epsilon information, or basically make it into an epsilon 2 by shutting down the volatility of theta, which is the random variable that beta multiplies. So if we set sigma theta to 0, this asymmetry result vanishes, which means that the asymmetry is really driven by the fact that beta multiplies the market factor. If beta was just a second additive shock, we would not get this asymmetry. For concavity, this is not true. We would still get concavity in price impact, even if beta was just a second additive shock. So that's why we want to emphasize the asymmetry result more than the concavity result. Concavity simply follows from having 2 dimensions of uncertainty. Asymmetry follows from one being beta information. The second set of results is about the moments of price impact. So because price impact is stochastic in our model, because it's driven by a random variable, total order flow, we can compute the first 2 moments of it. So we compute the expected price impact and the volatility of it. We refer to the volatility of price impact as liquidity risk because it captures the uncertainty about illiquidity. And then we compute the comparative statics. So we want to understand, how do the model primitives, for example, the average beta in the economy, how do they impact those 2 moments of price impact? And we show the following. So we show that expected price impact increases with all parameters that are related to the volatility of cash flows. What's the intuition? Well, all of these parameters that I list on the slides, for instance, the average beta and the volatility of epsilon and beta, these parameters increase the average cash flow volatility. Therefore, they exacerbate the market maker's inventory concerns and lead to higher price impact in equilibrium. Remember that price impact lambda was proportional to the market maker's variance of the cash flow. Then we also compute liquidity risk, and we show that it increases with factor volatility and the average beta. Intuitively, these 2 parameters increase the volatility of cash flow, conditional volatility, and therefore they increase the volatility of lambda. The second set of results is about asset prices and returns. So from the equilibrium price equation that I've shown you before, we can just take an expectation on both sides and get the following expression. So we can show that the expected price is equal to the expected cash flow plus a risk premium term. And importantly, this risk premium term depends on a relationship that is really specific to our model, the covariance between price impact on order flow. Why is it specific to the model? Well, because if we set sigma theta to 0, so that beta information becomes basically epsilon 2 information and being an additive shock, this covariance would vanish. So this risk premium is again driven by the fact that beta is a multiplicative shock, not an additive shock. At the same time, I want to note something here. So the market maker in this benchmark model holds 0 inventory on average because average demand by liquidity traders and informed traders is equal to 0. Therefore, you don't see the usual negative risk premium in the price in this equation. We do have an extension where the market maker ends up with non-zero inventory on average. In that case, we also obtain sort of the usual negative risk premium in the price or positive risk premium in expected returns. What we want to do here is we want to emphasize the role of this additional risk premium that comes from beta information. So what we show here, just in a nutshell, is that expected returns decrease in this covariance. And this covariance in turn decreases in average factor volatility, and it also decreases in the average factor loading. So we interpret those 2 findings as being consistent with stylized empirical evidence because the fact that expected returns decrease with average loadings is referred to as beta anomaly, and the fact that expected returns decrease with factor volatility is usually called the leverage effect. So those two results happen in our model too. Okay, so in the remaining 5 minutes, I would like to talk about one model extension and then a small empirical exercise that we consider. So the particular model extension that I want to talk about is endogenous information acquisition, because you might ask, okay, you impose a certain composition of traders, right? But would they actually choose to be beta informed or epsilon informed in equilibrium? What's the optimal composition of those traders in the long run? So what we want to do here is we want to say that informed traders are ex-ante identical, and then they decide whether they want to be epsilon informed or beta informed traders in equilibrium. So in equilibrium, the proportion of those two traders is determined by an indifference condition that makes basically all traders indifferent between those two sources of information. What we show in this extended setting is that our main results still hold. So in particular, price impact is still stochastic and asymmetric, so higher for large buys, lower for large sells, and expected returns still decrease with average betas and factor volatility. So our main results are robust. We also get some additional results from this extension. So for example, we show that even though the comparative statics of expected liquidity and liquidity risk are qualitatively the same, endogenous information acquisition changes the strength basically of these comparative statics. So for instance, the impact of these two parameters on expected liquidity are always stronger with fixed information. Those for liquidity risk can either be strengthened or weakened by endogenous information acquisition. Okay, so then the last thing that I want to briefly talk about is a small empirical analysis. So our model is primarily theoretical. What we would like to do, however, is we would like to test the novel empirical predictions that haven't been analyzed in the empirical literature yet. So the liquidity-related predictions have largely been analyzed. The asset pricing aspects of the model, not so much. And in particular, there are two predictions that we're looking at here. So our model predicts that this covariance between order flow and price impact is positively related to average betas, and it's inversely related to expected returns. And those two predictions we would like to test empirically. So what we do is very simple. So for each stock, we compute the correlation between order imbalance, which is a proxy for order flow, and price impact, which is a proxy for lambda. Then we use daily data, compute these correlations on a 3-month rolling basis. And I'm going to be brief here. There are more details, obviously, in the paper. And then we also compute monthly market betas using a 60-month rolling window. What do we find? We find that both predictions get empirical support. So the correlation between order flow and price impact is actually positively related to average betas. To show that, we sort stocks into quintile portfolios based on their betas. And then we find that the correlation increases across portfolios. The difference between the two extreme quintiles is statistically significant. And we find similar results for factor volatility instead of average betas. The second prediction that we are testing is the inverse relationship between expected returns and this correlation. We do this using Farmer-Macbeth regressions. We find that statistically speaking, the correlation is inverse and significant. It also seems to be economically important, because if we increase the correlation here by 0.1, by 0.1, that leads to a reduction in annual returns by about 0.5 percentage points. Okay. So just to conclude, what we do here is we look at a setting with private information about beta and epsilon. The important takeaway is that there is an economic difference between those two types of information, because beta information is information about a loading on a random variable. And as a result, it not only changes the expected cash flow, but also the variance of it. We have two sets of main findings, one about price impact, one about asset pricing. About price impact, we show that price impact is stochastic and asymmetric. As a result, we get liquidity risk endogenously in the model. And price impact is asymmetric because it's higher for large orders and smaller for large sell orders. We get a positive covariance between price impact and order flow. That covariance creates a wedge between the expected price and the payoff, and therefore it allows us to make predictions about the expected return. And we show that this covariance increases with the average factor loading and factor volatility, and we provide some empirical evidence for this finding. Great,
good.
Thank you.
Very good, thank you very much. We have now the discussant, Liyan and Andrei from McGill. So thank you, Daniel, for discussing this paper.
Okay, thank you. Thank you first for having me. It's a pleasure to be here online and to discuss the paper. I hope everyone can see my my screen well and can hear me well. Okay, so I'm happy to discuss this paper. Jan did an excellent job, a great presentation. So I'm going to spare you the details. And what I will do, I will start directly with the main observation of the model. So the main observation of the model is based on this equation here, which is an equilibrium price. So the equilibrium price is driven by an expectation of a future payoff given the order flow minus a risk premium term. So it's a bit weird how you see that risk premium term there, because minus X is actually the quantity that is held by the risk averse market maker. So that's why I wanted to put minus X in there in order to make sure that actually you can look at this price as an expectation minus a discount term. Okay, so in the paper, if you look at the paper, you're going to have a plus there, but just because of this. Now, the main observation is in the term that is highlighted in that variance over there. So what is happening is that when there is a large buy order, that implies for the market maker that likely the beta of this asset, or investors have information that the beta of this asset is high. So you see information about beta and learning about beta from the investor side is very important for this result. But if the beta is high, then it has this multiplicative property that actually it magnifies that variance that you can see over there, which means that actually this required risk premium by the market maker will actually depend on the order flow. And you can see it right here. This is a figure from the paper. You can see that the price is a stepwise function of this order flow. And you can see when X is low and when X is negative, then you have a lower price, so you have that discount. When X is positive, then you have a higher price because it's the other way around. Now, the important thing here is that this stepwise function has a slope that increases, that is higher, if you want, on the right hand side. So that slope is exactly that term, gamma over 2 times the variance of V over X. And that is actually the main mechanism. I can formulate this main mechanism in another way. And actually, it's important also to see it this way. The covariance between gamma over 2 and that variance of V conditional on X and X, so the covariance between that term and X, it's larger than 0. If you want, the slope of the line that you see on this left-hand side plot is actually higher on the right-hand side. So that's the way you should think about that covariance. Importantly, that term there that you have in the covariance, the highlighted term, is the price impact. So the covariance between the price impact and order flow is larger than 0. On the right-hand side, I plot that slope, the slope of the piecewise function that you have on the left-hand side, and you can indeed see that actually you have this asymmetric pattern. There is a concavity there, but actually the asymmetric pattern, in my opinion, is the important one. You can think about it like this. Assume that you simulate 1,000 points of X, and then you look at a scatter plot. Of course, you're going to have a positive covariance. So now, what is the implication of this covariance? Well, it does have some asset pricing implications, and this is the second part of the paper. But that's the one where the authors provide some empirical findings. So I believe this is the most important part, and I'm going to talk about it. So what are the asset pricing implications of that covariance? If you think about the risk premium, on an asset, then it is equal to minus that covariance. Remember, the covariance is positive, which means that minus covariance is negative. And as I told you, the covariance increases with order flow and increases with this beta of the assets, which actually means that actually you have a relation between covariance and beta, and you also have a relationship between beta and the risk premium. So there are two testable implications. First of all, the covariance is higher for high beta assets, and this is confirmed in table 1 of the paper on the author's own calculations. And then expected returns are lower for high covariance assets. So if you want, expected returns are lower for high beta assets, and this is confirmed in table 2. Okay, which means that actually investors' private information about betas may explain the beta anomaly. I think this is the main result, in my opinion, of the paper, and the beta anomaly is the one that says that high beta stocks underperform low beta stocks. So it's important to consider this mechanism of private information about beta, because it might explain exactly this well-known anomaly. I think it's a very simple result. I think it's intriguing. It's backed up by the data. And actually, my comments here are just meant to help reinforce the message of the paper. I don't think the message of the paper should change. I think this is an important finding and an important paper. Okay, so here are my comments. First, this is the beta anomaly. So let's think a bit about the beta anomaly. These are 5 portfolio beta sorted portfolio. And now here you have the KPM implied excess returns on the horizontal axis, and you have the realized excess returns on the vertical axis. And as you can see, the main finding is that actually the line of these dots is actually flatter than the 45 degrees line. The KPM says that actually you should obtain a 45 degrees line, but you can see that the KPM is flat. Now, the beta anomaly on the right-hand side says that actually assets that have a high beta underperform relatively to assets that have a low beta. And you can see it from the plot. And this is with US data. This is from one of my papers, but you can do it with any data you want. You're always going to get exactly the same thing. Now, what I struggle to understand from the paper is if it can explain the left-hand side. So you see, the analysis in the paper, as Jan said, is an asset-by-asset analysis, which means that I struggle to see what are exactly the betas of the assets. The betas that they have in their paper are actually cash flow betas, and it would be great to build a full-fledged multiple asset model and to compute the true market betas, and which are not exactly the same as the cash flow betas, and also check the return of the low beta assets, because you see high beta assets, they underperform, but low beta assets, they overperform. And it looks like the term that you have in there, that minus covariance, is always something that is dragging the expected return slower. So I'm not sure how exactly this will play out, and if indeed this will generate the full-fledged beta anomaly as you know it in financial markets. If this model is not able to show what is happening on the left-hand side, then you will have to discuss in the paper, and this is a discussion that is missing, you will have to discuss in the paper if there is a different mechanism for the left-hand side. So for the moment, I'm not really convinced about this explanation that you have, just because actually I don't see the true betas, the real betas of the assets in a full-fledged equilibrium model. And I think there is a very simple step that you have to do. You already have an asset or multiple asset economy. You're going to just have to compute the betas endogenously. They are, of course, related to the cash flow betas, but you're going to have to do this exercise to convince me that actually also on the left-hand side, you obtain the desired result. I have also a comment about the robustness of the theoretical results. So here, the expected return of the asset was minus that covariance that you can see over there. But actually, there is another term that is not neglected in the analysis, but actually is easily removed by assuming that the expectation of the order flow A of X is equal to 0. Of course, if you remove that term, then you have all of the results of the paper. But now we know that assets are actually in positive net supply on average, which means that A of X over there should be higher than 0. There is a counterbalancing force that this term is going to bring if expectation of x is higher than 0, that counterbalancing force is going to increase expected returns when beta is high. So it's not sure which one dominates. Of course, the authors are aware of this thing, and actually they check this in the appendix, and Liyan stated this also during his presentations. And on the page 74 of the paper, I was happy to see that the results in corollary 3, which is this main result, continue to hold when E of x or beta is sufficiently small, which means that actually the result is not that robust after all, because the result weakens exactly for large beta assets. So for the moment, I'm not really convinced by this simple robustness analysis, and the authors will have to talk more about this and what does it imply for their theoretical model. And I think there is a way out, and I think there is a very, very nice thing that they can do. This also suggests an additional prediction. You can see on the page 74, they write that actually this holds when A of x is small or beta is sufficiently small. E of x is the net supply, is the expectation of the net supply. So that means that if large beta assets tends to be small or in small supply, then the result still holds. So what does the data say? I think in the data, indeed, we have the large beta assets are in small supply, which means that actually this can be a very nice implication of the model to show that indeed this feature here that is somehow missing in the paper, which is highlighted over there, is actually not a big deal, and it's actually also one more check of the theoretical model. I also have comments about the empirical analysis. The empirical analysis uses the correlation between the price impact and the order flow instead of covariance. So this should be fine, of course, but then I looked at the corollary 2 in the paper, and it states that the volatility of the price impact increases with beta. So if we think about the correlation is covariance divided by the two volatilities. So the covariance increases, but also the volatility of lambda increases, which makes me think I don't know exactly what is happening, and I don't know if indeed the results should also hold with the correlation. But there is also a very nice way out of this. You should just try to simulate the model, and you should check if indeed the results hold with the correlation, and that would be perfectly fine for me, and would justify your empirical analysis using the correlation, which is of course the right thing to do in the empirical analysis. Also, I think the empirical analysis is rather small. You can stop here. We should show us some additional empirical evidence. And I thought about some empirical evidence that can come out straight of the model. So there are some theoretical predictions related to idiosyncratic volatility that I think you can find. So idiosyncratic volatility will show up as being priced, but I don't know if the sign will be positive or negative, but this would be up to you to see, and this would be up to you to check if in the data there is some relation between idiosyncratic volatility and the risk premium. I think it is, but there is a debate in the risk judgment. Well, there are also some theoretical predictions about firm size. So now I told you that actually large beta assets tends to be small in size, which means that actually you should really check that prediction that will solve both your issue with this robustness of the theoretical model, and will add some theoretical predictions that confirm your theoretical analysis. Now, you also, for the first part of your results, you said that this is consistent with empirical evidence, but that evidence is 30 years old. So maybe you can update that evidence to see if indeed it's still there, and that will reinforce your theoretical message, and you will make your paper more complete. Overall, I think this is a very interesting mechanism to explain the multiplicative nature of beta information, a promising direction for future research. Just a few clarifications about the theory part would reinforce the message and needs more convincing empirical work. This is an easy revision. Good luck with the paper. And I also have a suggestion for further work. You should think about this mechanism in a dynamic model and have a look at a beautiful paper by Shiyang, who actually shows that learning about predictability generates some asymmetric effects, of course, into a dynamic model. So that is perhaps a future direction of research. Thank you.